So this is going to be a proper no-nonsense session. We'll be discussing serious finance, and I'm very sure end of the session, all of you will go back with some value addition in your lives. To start with, we'll be beginning with basics of financial planning. Now this is something very simple that I'm sure many of you are aware about, so I'll be rushing. But anywhere you have any query, anywhere you feel I'm going fast, please let me know so I slow down. So to begin with, savings and investments. We've always been hammered since childhood ki save money, save money, save money. Times have changed. I mean, now if you save money, you're not really making anything. As a businessman, as a professional, you can work only for few hours. You make money when you're working, but your money is making money even when you're sleeping. So investments is the way to go ahead. Your savings should be restricted to your emergency fund. That's it. Imagine this situation, you've gone on a holiday, you're on a beach, you're sipping your mojitos, and you come back from the holiday and you're a richer person. So that cannot happen with savings. That will only happen with investments. So start your investment journey. If you have not already started, today is the right day to start. And all of us, I mean, everybody wishes that they would have started when they were younger. You will never be this young again. So start investments today. Your future self will thank you for it. There's one quick tip that I wanted to share with you all here. So most of us have our savings accounts where we keep our emergency fund. So ideally what I feel is you have to have 6 months money in your savings account. Activate sweep facility. All your banks will have this facility. If you haven't already done it, do it now. When you're keeping money in your savings account, you're generating what, 4% per annum. But when you activate the sweep facility, your excess money goes into a FD. That can be broken anytime. But you generate additional 2%. Now 2% seems to be a very small amount, but any money made without any effort is good money. So yeah, this is something that everyone should do. And no discussion on compounding on investment is complete without compounding. So this is applicable more for our children than for us. You have to invest for them right now. So 20 years down the line, they sit with a huge corpus without them even starting earning. So make use of compounding. It will be really helpful for you and for your family. Now, regarding compounding, I just want to share a quick example. Now, say there are two people, A and B. A starts investing 50,000 rupees at the age of 25, 50,000 per year, and stops investing at 35. B starts investing same 50,000 per year. A has invested for 10 years, B has invested for 25 years. Let us assume that both of them have made a meager 10% per annum. Who do you think would have made more money, and how much do you think they would have made more? Anyone? Yeah, you have to answer. Yeah. So see, basically B has invested for 25 years, A has invested only for 10 years. But just because of compounding, at end of, when they attain 60 years age, A would be sitting with 86 lakh rupees while B would be sitting on just 49 lakh rupees. So that is the advantage of compounding. That will help you only if you start investing sooner. The sooner you do, the better. Best day to invest was yesterday. Second best day is today. So just start it now. Now this is something that I have learned from Rakesh. So we were having a discussion. He just mentioned it out randomly and it hit me. It is something everyone knows but not many people discuss. I thought I'll just put it forward. So how do you know you're rich? There's a mindset. Poor mindset is that whatever I earn, whatever my expenses I'll spend, whatever is left I'll save and invest. But a guy who has a rich mindset, he will first decide how much he wants to save or invest, and based on that, whatever is left is what will be his expenses. So yeah, Rakesh, thanks for getting this to my mind. And yeah, this is a simple formula that I have to know whether you're rich. A person having a net worth of say 1,000 crores might be a poor person. A person with a net worth of 1 crore would be a very rich person. How do you decide this? So what I feel is, if your current income from your job, your business or whatever is equal to your expenses, and your passive income, be it your FD interest, be it your mutual fund dividends, be it your rental, whatever, is at least 2 times of your income, you're a rich person. Doesn't matter if it is 10,000 rupees or it is 10,000 crore rupees, because your expenses will be taken care of by your active income. And your passive income will keep compounding, and in 10, 20, 30 years, you won't even realize the kind of corpus you would have developed. Now we've spoken about the hero of investments, compounding. There's a villain also, inflation. Now, most of us have our financial goals. We decide I want to be worth so much at so and so age. At 30, I want to be worth 100 crores. At 40,000 crores, 50, 10,000 crores, whatever numbers you have in your mind. But whatever numbers you decide, you are deciding them based on today's value. You have to make sure that you are incorporating inflation. And inflation also, what we get from government, I don't believe that. I mean, it is a correct value, but government inflation is calculated taking many products. They have a basket of products that they consider. That might have your daily use things, your household goods, your food, that has your cars, that has your phones, and it has a similar weightage for everything. Now your onion, tomatoes you buy every day. Your iPhones you buy probably once a year or once in 2 years. Your cars you buy in 5 years or 10 years. But if you see the price that is going up, the things that you use daily, they are increasing in price at a much more rapid rate than your products which you buy once in 5-4 years. So best way to best way to calculate inflation is whatever inflation government gives, just add 2% to it and you'll get a fair value. So if I give a quick example, let's say you have 1 lakh rupees today, you decide that I want to buy a phone, but parallelly you think that, okay, right now I don't need the phone, I'll keep this money in a FD, or I'll just keep it in my savings account. 5 years later, I'll buy the phone. So in 5 years, my money would have grown. I'll have some extra money. But what happens is, if you forget the savings account interest, that is hopeless. Say you've invested in a FD, you got 6% returns. Inflation has gone up by 8%. So 5 years later, your 1 lakh has become 1,30,000, while the article that was costing you 1 lakh is now 1,40,000. So despite of doing the correct thing, despite of investing, despite of saving, now you don't afford something that you were affording 5 years ago. So make sure that whenever you are making your financial goals, you have inflation in your charts. So now that we've spoken about investment, where do you invest? I want to share some good investment avenues that are available for us. So when you are making investments, there are just 3 parameters that you have to consider: safety, liquidity, returns. Now, unfortunately, in any investment, you will never get all 3. So depending on your risk profile, depending on your appetite for returns, you will have to choose what you want to invest in. For example, FDs and debt funds, they give you very good liquidity, they give you very good safety, but the returns are hopeless. There are stocks and mutual funds, they give you very good liquidity, they give you extraordinary returns, but your money is not safe. If you invest in good real estate, you have very nice safety, you have good returns, but there's no liquidity. So you, based on your requirement, you have to choose what is your right investment. And any investment is subject to risks. And risk is directly proportional to your returns. This we are aware of, that lower the risk, lower the returns, higher the risk, higher the returns. But again, there's a catch. Especially for the people of our age, of our financial stature, we want to grow very rapidly. And all the people running Ponzi schemes also know, so we are their perfect target. They know that we'll be ready to invest if they show us good returns. So that is why we get trapped in these penny stocks, in crypto. I'm sure many people have burnt their money in crypto. Many of you have already shared with me that they've burnt money in crypto. Then there are those pump and dump schemes. So wherever you see that the returns are extraordinarily high, you take it for granted that there are no returns, you're going to lose money. So that is something you have to keep in mind. Now, these are the various investment avenues that we have. The simplest one is bank deposits, your FDs and RDs. These give you about 6 to 8% returns. Ideally, whatever money you need for bank guarantees or some safety money that you need should go here. Otherwise, your investment should not go here. Otherwise, you will not even be able to beat inflation. Then next is post office schemes. These are very similar to the bank deposits. So these are not even there for us ideally. These are for the tier 2 towns, tier 3 towns, or the villages where banks are not accessible. These give you very similar returns. Now NSE, the National Saving Certificate, that is a very famous kind of investment in post office scheme because it gives you ATCE benefits also. Then the next type of investment is bonds and debentures. These are debt instruments basically, which either companies offer to you or you invest through mutual funds in them. These give you fairly decent returns with comparatively much lesser risk. You can expect anywhere between 8 to 10, 11, even 12% per annum with these. Next are the corporate FDs or company FDs. These are similar to your bank FDs, but they are provided by companies. Now, only difference is that unlike bank FDs, these are unsecured in nature. Unsecured as in, if the company exists, you will get your money. But if company goes into bankruptcy, then you won't get your money. So if you ever decide to invest in company FD, make sure that you are doing it only in AAA rated companies. And the next one is bullion. Is a very good investment for multiple reasons. Firstly, it grows like other investment avenues. Secondly, it is inversely proportional to your stocks. If something happens, something wrong happens, COVID or war, whatever, if your equity portfolios will take a very big hit, but at the same time your gold will increase in value. So it will be a natural hedge for your investments, and it provides you appreciation also. Now the next point, probably the female folk here will not like it, but if you are investing, I see many people, we are buying jewelry as an investment. Jewelry is not an investment. You want to buy jewelry, you buy it. Tell that you want to spend and you spend. You are making money, spend it on yourself, that is okay. But if you are buying jewelry for investment, that is wrong. You are paying your jeweler making charges.
I think we have to record this.
Yeah. So you are paying your jeweler making charges. You don't know how pure your jewelry is. There is safety of where you will keep it. There is threat of it getting stolen. Then even when you are selling it back, you don't know what kind of rates you will be offered. Again, at that time they'll be taking some charges. So the best way to, for investment, again, for your matlab shauk hai udao low jewelry, but if you want to invest, then digital gold is the right way to go ahead. Among digital gold also there are many avenues. There are gold bees, there's this HDFC gold ETF by HDFC. Every bank has it, but the best thing to do is buy sovereign gold bonds. Again, these have two extra advantages over your other digital gold. First is that sovereign gold bond is backed by Government of India. So the only way your investment goes is if India goes bankrupt. If India is going bankrupt, you are already doomed. So it doesn't matter if your gold is going. And second thing is that it provides you 2.75% additional interest paid every 6 months to you. Now again, like I told you for the auto sweep facility, 2.75 seems like a small thing, but you are getting this without any effort. So any money without any effort is good money. So this is something very good that you can do. Next is real estate. Now real estate is the best investment you can make if very strong, if you are able to handle it, because it comes with three major concerns. First concern is the divisibility. Now I buy a house today only for reselling it. 1 year I buy it for 1 crore, let's say. 1 year later it has appreciated like anything. I got lucky, it is now worth 1.5 crores. I want just 15 lakh rupees. Nobody will buy a kitchen or a bathroom from me. I'll have to sell the entire house. Now for a 15 lakh in requirement, I have sold 1.5 crores. I've spent my 15 lakh. I'm sitting on 1.35 crores without knowing what to do with it. So that is one divisibility issue. Second thing is encroachment risk. So all the bad elements of the society are ready to attack you. If you have the muscle power, if you have a way to protect it, then nothing like it. Otherwise, that is one issue. Final issue is liquidity and tedious paperwork. Now again, like I told you, my 1 crore property has gone to 1.5 crores. But now getting a buyer at 1.5 crores would be firstly a big challenge for me. Secondly, giving them the right paperwork, their advocates will take 1 month to just clear it. So these are some issues with it. Otherwise, that's the best possible investment. Then the next one is equity shares. This is my personal favorite, because you become a part owner of whichever company you invest in. Today, however rich you are, there's a capacity of employing people. But as a shareholder, today I will employ Mukesh Ambani. I'll buy Reliance shares. Now he is working for me. After 1 year, I decide Mukesh Ambani is not working well. I will fire him. I'll remove the shares. I'll hire Gautam Adani. So that is something you cannot do in your company. You can do it only in case of equity shares. So that is the best part. You are becoming a part owner of a company which has the best of the best minds in the country. Then again, this investment is very, very volatile. And here again, one more thing, avoid penny stocks. Many people have this in mind. A stock is trading at 20 paisa, it won't go to zero. But 20 paisa will go to 5 paisa, and that means your 75% wealth invested there is eroded already. And maximum chances that it happens. There are very rare cases where a 20 paisa stock goes to 20 rupees or whatever. So avoid penny stocks. Then there's mutual funds. For the people who don't have much knowledge about equity, this is the best possible way to invest money. There's an expert who's handling your money. You are paying them a bare minimum charge. It comes with two major advantages. Firstly, there's an expert who's handling your money. Secondly, there is division, because you will invest in one stock, but a mutual fund invests in 20 stocks. Even if their Firstly, they are experts, so they'll invest in good stocks. But even if their judgment goes wrong and one or two companies fail, still your money is divided. So there's no risk, only your part money would go, but the other money would generate enough returns to make up for it. Now this is a financial pyramid that I have made with what I thought, probably with your risk appetite, with your aspirations for returns, you can decide what you want. So belong to the poor or middle class, so I'll not touch upon them. But as a rich individual, you can ideally target that 80% of your money goes into the top 3 slabs, of which better that if you restrict to the third or second slab, and 20% of your money needs to go to the bottom 2. That is because of the safety. You don't want that when you need money. Now, let's say I've bought some stocks on mutual fund today. 9 years they have grown like anything. 10th year I need the money, and 10th year is the COVID year. So 9 years of effort is gone. When I have to liquidate, I'll have to liquidate them for the money, and I have lost everything. So that is the reason you have to have some money in your safe investments that you can encash whenever you need. So now that we've done with investments and some investments avenues, I just wanted to touch upon insurance. Bola.
Ashish, like in your earlier slide, like if you have a corpus of example 1 crore. So if you have a corpus of 1 crore, based on this, can you just explain?
If you have 1 crore,
Yes.
real estate is gone for you. You will not get a good real estate. Ideally, invest in growth mutual funds. Do not touch collectibles or penny stocks. Do not touch speculations. Now, AIF and PMS are two very good options. I'll just talk a little about them. AIF is alternate investment fund. If you have a minimum 1 crore budget, there are companies where like your regular banks also do it. So they will allot you units. In fact, RC's company does PMS as well. So they will allot you units, and they buy, sell, trade, hedge, whatever, they do it for you. And end of the day, whenever you encash it, you get the money. PMS is if you have minimum 50 lakh worth of investment, you won't get units. They buy stocks for you that come to your portfolio, but the entire churning, buying, selling is done by them. So these are two very good avenues which you can choose. But if 1 crore is your net worth, then you don't have to do this. 1 crore is your investment that you want to put in. AIF, PMS, growth mutual funds are the best ways to go ahead, or blue chip companies. You cannot go for real estate, and collectibles and penny stocks have to be avoided for sure.
There's a fund called SIF,
I'm not aware.
Specialized Investment Funds.
I'm not aware. I'm not aware. So yeah, they have, it's a smaller thing, but that is not operational as of now. Yeah.
Which has to do, which has some exposure on real estate, where you can buy some stocks. I remember talking.
Correct. But no, not my area of expertise, so I'll not get into it. But yeah, they're there. But I don't have much idea about it, so I don't want to get touch. Now, insurance also, many people take it as for ROI. Some of your agent will come and tell 10 years later it will mature, you'll get so and so money. Guys, keep your investment separate, keep your insurance separate. Insurance has to be purely insurance. Investments can be investments. Your insurance agents will always suggest you fancier plans which will give you returns, like endowment plans and all. But you have to understand, they suggest them because they get commissions for it, and those commissions are going from your pocket. So if you want returns, invest your money. You want safety, insure yourself. Don't mix both of them, because your premiums of your traditional plans, term insurances, will be much lesser than your endowment policies. Ultimately, if you see 10 years down the line, if you have invested separately and taken a term insurance, you will come out with much better returns. So keep that in mind. Now there are two types of insurances: life insurance and your medical insurance. Life insurance, again, there are 4 kinds. Like I was sharing, term insurance, this is the purest form of insurance. Everybody should have a term insurance ideally. So it is very simple. You have a policy for 15 years. Every year you pay a premium. In 15 years, God forbid, if you pass away, whatever was your insurance value, your family gets it. Simple vanilla thing. Next is the endowment policy. This is something that every insurance agent will promote. So after your maturity, you get some money. But if you calculate the CAGR, you come out with less money than a bank FD. It is absolutely hopeless. Never go for this. The third is a whole life policy. Now this is very similar to term insurance, but there's one difference. In term insurance, like I said, now if you've taken a 10-year policy, after 10 years it's expired, so you have to take another one. But what happens is, today you are 30-year-old, and insurance policy premiums are directly proportional to your age. So today you've taken a policy, you are 30. Next time when you take at 40, the premium would be much higher. Second thing is, when you are 40, if let's say you've just missed it off, you've not renewed your policy or something has happened about it, God forbid 42 years you pass away, your family gets nothing because you had forgotten to renew your policy. So this is one avenue that has come into picture for that. So whole life policy is that again you have 10 years of paying premium, but once you are done paying premiums, you don't have to pay anything, but you are covered for your life. The premiums obviously are higher. So anybody who affords whole life policy, it is always better to go for it over term insurance. Then finally, final option is your ULIPs. These are unit linked insurance policies. So here what happens is your these are charged higher than your term insurance, but the money is invested in stock markets or in debt funds, whatever you choose. So you get fairly good returns. Again, this is good, you can go for it, but it is better to avoid it and keep your insurance and investment separate. Now, medical insurance, mediclaim, I'm sure everybody is aware of, but there's one catch in medical policies. You have to be admitted in the hospital for 1 day. Now, just to overcome this problem, you have to go for personal accident insurance. This will cost you peanuts. It is a top up over your medical insurance, but it is very helpful because if you have a personal accident insurance, you are covered even if you are there in the hospital for 1 hour. So make sure that you have both the policies in place. Now insurance has to be there, but how much insurance? Of your annual income, and depending on your budget, it can go 20 times. The reason I have this 20 times in my mind is, say your annual income is 10 crore, or let's say for now your annual income is 1 crore rupees. You've taken a policy of 20 crore rupees. God forbid you pass away. So 20 crores straight away comes to your family. Now they won't be like, yeah, he died, let's buy a Lamborghini or a mansion. They'll assume they put it in a very safe, avenue. They put it in a FD. Or they put it in a debt fund that is generating 12% ROI per annum. Now what happens, you were earning 1 crore, so they are used to living in 1 crore per annum. They've invested 20 CR or that they've got. So every year they take out 1 crore, but at 10% per annum, that 20 crores is adding 2 crores to the portfolio. So in 5 years, in 10 years, even though they are taking out as much money as you were generating, they still have a valuation that is much higher than what they initially had. So that is the reason I have 20% in my mind. But again, depending on your budget, you can go between 5 and 20%, 20 times of your annual income. Then whom do you do it for? Again, life insurance is not a jackpot. Nobody, if you are not working or your wife is not working, today if somebody's wife passes away, same thing. He won't say, yeah, she passed away, I need 20 crores, I need 50 crores. That is not the logic behind it. So any family member who is not earning, they don't need a life insurance, because no matter you feel very bad, your family member is gone, you may be taking a very bad hit personally, but financially it is not mattering insurance. Coming to medical insurance, everybody, be it your child, be it your grandfather, be it 5-year-old, be it 90-year-old, should be insured properly. And again here, these are values that I have come up with. You can, based on your expense, based on how much budget you have, you can choose something. But what I feel is 2 lakh minimum to 5 lakh is a good insured amount, because you will be taking as a family insurance. So if you are a family of 4, you've taken 5 lakh per head, that becomes a 20 lakh policy. 20 lakh per annum is good enough amount as per me, and one person can claim it, and you have some top up facilities, so that is good enough. But again, you can choose what you want. And yeah, so once we are done with insurance, the number we had Dr. Velumani, and I had brought this up to him, that if I am able to generate more money taking loans, then I am making money off bank's money. Why shouldn't I take loan? But he was of a very strong opinion, for peace of mind, do not take loans. And most of the influencers, financial influencers you speak to, they would tell you the same thing. Don't take loans, they'll bring burden to you, you'll not have peace of mind. But I personally feel if you are able to generate good money, you should take loans, and I have divided them into 2 types, good loans and bad loans. Bad loans is any loan that is charging you more than 10% per annum. If you have a bad loan, clear it right away before you start investing. If you have a good loan, invest that money instead of clearing it. Now, what are the types of loans that are available to us as businessmen? I'm not talking about students and all. This is purely for all of us. So first is personal loan. This is essentially the worst type of loan that you can take. Avoid it at any cost. These are unsecured loans. You will be getting calling from Bajaj Finance. Congratulations, you have a loan. These are those loans. Cut their calls. because you'll be in trouble. Now they charge you, they don't take anything from you, no property, no collateral. So the values of these loans are 13 to 14%. Now if you decide to take this and put the money in some mutual fund or whatever, if you get lucky, you might generate 20%, but ideally you will not. So investment would become useless because more than that you are paying. Plus your investment might make 18 to 20%, but this loan will definitely take 13 to 14%. So that is a risk that you should avoid. Now, one reason people take these loans are emergencies. Now, if somebody's wife is not keeping well, some accident has happened, or their parents are not feeling well, at that time, when you need money for a treatment, you will not think about the rate of interest. So that is when you end up taking such loans. So that is the reason in my first slide I had mentioned that always have at least 6 months of your income as safety net. That should be there, so you don't get trapped in such kinds of situations. Then the next second type of loan is loan against securities, LAS. These are very good loans. So if you have mutual funds, you have debt funds, equity, whatever funds, you can pledge them to banks. They will give you limits for it, and you can use those loans. Now these come with very good advantages. Firstly, the rate of interest is very low. Depending on your CIBIL, it can be 8%, 9%. And secondly, there is no EMI, fixed EMI. So whatever you use, say I have 10 crore worth of limit available. I've used only 5 lakh rupees. I pay interest only for 5 lakh rupees. So that is one very good flexibility that is available. And LAS is also available for your FDs. And every bank has this fixed rate. Say your FD is generating 6% returns, they will take 1% extra. So you have to pay interest of 7%. This is essentially useful if you need money for 1 month, 2 months, or for short term. Now I have a shipment coming from abroad. I have to pay customs some money. It makes no sense to encash my FDs, get that money, pay them, then generate money, again put in a FD. You end up paying a lot of taxes. So if you take this facility, for say you've taken 1 crore worth of FD, you've pledged it, you've used that for 2 months, you pay 7% on it, but your FD is generating 6%. So ideally you are paying only 1% per annum extra. So this is something that you can use for short term. This is not at all useful for long term. If you need for long term, then encash your FD, because there's no point paying bank any money unnecessarily. Then the next type is a home loan. This ideally is the best loan that you can take. Even if you don't need home loan, take a home loan and invest it. You will get that home loan at 7% rate of interest. Don't put it in equity. Never do that, because if something goes wrong, you don't want your family to come on roads. You want to have that house. So take a home loan at 6-7%. Invest it in a very safe debt fund that will give you 10-11%. So you are ideally using banks' money to make money. And again, if you see 7% versus 10%, you are making only 3%. But as I have been mentioning, any money that without any effort you are making is good money. So no harm in it. And when if you are doing this, then make sure that you take an insurance on that loan. Because again, let us assume the worst, God forbid something happens to you, your family shouldn't have to leave the house. That insurance will take care of the loan. So they have their house with them. Now, this is one very interesting thing. I am very sure that whatever we discussed till now, most of you are aware about. But reverse mortgage is something that not many people know of. This is exact opposite of home loan. So right now, none of us are eligible for it, but I'm sure you must be knowing many people, your staff, your workers, your friends, family, relatives, whoever, who might need this. So this is something good you should know. In a home loan, you buy a house, you pay EMI every year. Once your loan is over, you get the house to yourself. In a reverse mortgage, this is applicable for people who are over 60. So if it is a couple, one spouse has to be over 60 years of age, other spouse has to be over 55 years of age. So by a registered will deed, you write the house to your bank, for which they calculate the valuation, and based on that a EMI is decided. Now bank gives you EMI every month, and this keeps continuing till both the spouses pass away. If one of the spouse pass away, bank cannot take the house. It will be taken only after both of them pass away. Now how it works is, unfortunate, say you are a solo person at 60, you've taken at 62, you pass away, jackpot for the bank. But if in the reverse case, you're 60, you've taken it, you live to 105 years, bank cannot tell that I've overpaid. They have to keep paying you every year till you pass away. So this is very useful for people who either don't have children, or their children are not taking care of them, they don't want to give them anything, or their parents are abroad, their children are abroad, they don't need the funds. So if there are such kinds of situations, reverse mortgage is a wonderful thing. Enjoy your house till you're alive. After you're alive, you don't need the house, but bank gets it, but you keep getting money till you're alive. So this is something about reverse mortgage. Credit cards, there's a lot of debate. Credit card is good, debit card is good. In my personal opinion, credit card is far superior than debit card for very reason that you get a credit period. Now, if a person is disciplined enough to pay the credit card bill on time, then if I'm using a debit card to pay for something, my money is going today. If I'm using a credit card, depending on the payment cycle when I have swiped it, I get a interest free period of 20 days to 50 days. So again, 50 days, my money is generating returns for me that I have already spent. A small difference, but any money that is coming to you free of cost is good money. So this is a very good advantage. Second advantage is that it helps you increase your CIBIL score. Now, these are some things probably I hope you are aware of, but otherwise I just wanted to share. CIBIL score is, people say that people don't know how CIBIL score is calculated, how it comes into action. People know CIBIL score, but they don't know how it is done. If you see this, every bank has to report to CIBIL on 30th or 31st of the month, last day of the month. So to maintain a good CIBIL score, it is advised that you use not more than 60 to 70% of all the limits that are available to you. Say I have a credit card, I have a limit of 10 lakh rupees. Ideally, I should not use more than 6 to 7 lakh rupees. So the bank has this trust that yeah, he has sufficient money, but he doesn't use it. That is the logic behind it. But if I need the money and I have spent 8-9 lakh rupees also, what I can do is I can make at least 2 to 3 lakh rupees payment before 30th of the month. In that case, when the CIBIL reporting is done, still it goes that I have utilized not more than 60-70%. So that would help you increase your CIBIL score. But very big disclaimer on this, take this only if you are disciplined enough to pay the bill in full. Paying EMI on credit cards is the worst financial decision you can make. They charge you 3 to 4% per month. Sell your house if you have to, but clear your credit card bills. Do not keep these. Another good reason for taking loans. Now, this is not for credit cards, but ideally for any particular loan, that even if you don't need loans, make sure that you keep taking loans on and off and keep repaying on time. I'll share a simple example. Now, Aditya is there. He's a very good friend of mine. Tomorrow I need 10 lakh rupees. I'll request him, Aditya, kuch kaam hai, de de. He'll give it to me. I hope he will. So yeah, I pay him back in I tell him I'll give in 15 days. I pay him back in 15 days. Next month I again ask him 10 lakh. He'll give it. I pay him back. This happens 2-3 times. Then one day I ask him 50 lakh chahiye. He has that trust. He's seen ki 5-6 times he's taken 10 lakh. He's repaid. He'll repay and he'll give me. But today right away I go and ask him, I need 50 lakh, you give me. Regardless of how close friend he is, he'll have it in mind. Ki I don't know whether he'll repay, what will happen. So the same applies with banks. If you keep taking loans, at the right day when you need a loan, you'll be eligible for it. Otherwise, there is no CIBIL score of yours. They don't know whether you'll be repaying or not. So that way, taking loans is very good. I've been mentioning CIBIL score. So what it is? I want you all to check your CIBIL scores. So go to the CIBIL website. They'll prompt, make payment, take a plan. Don't do all that. Just go for the free plan. Free CIBIL plan allows you to check your CIBIL score once every year. Why I don't want you to take a CIBIL plan is that if you have it, check on CIBIL is done. And hard check on CIBIL reflects on the points and your points reduce. CIBIL score reduces. Soft checks, they say that it doesn't impact, but multiple times when soft check is done, that also adds to it and you end up losing on your CIBIL score. So if you will have access to it, you won't be able to control, you'll keep checking it and that will mess up. And ideally your good CIBIL score is 750 plus. So check it, go for the free check. If your CIBIL score is 750, put an alarm for next year, forget it. But if your CIBIL score is less than 750, then they have paid plans, it will cost you nothing, 500, 700, 800, something like that. Take it because then you will be able to check what has gone wrong. Correct, it showed that HDFC has been reporting that I defaulted. Now when I went in depth, I realized that for one whole year, every month HDFC reported that I am not paying 300 rupees. And that 30 rupees they waived off, but my CIBIL score went from 800 to 650. Had I checked it on time, that wouldn't have happened. And the worst part about CIBIL is that your 20, 30, 40 checks clear in time or 30 payments go in time, your CIBIL will improve by 1 or 2 points. One default, your CIBIL falls by 20 points. So that is why you have to check your CIBIL. Make sure you check it today if you haven't already checked. If it is 750 or above, forget it. If it is not, then get into depth and check what is going wrong. SEBI definition, a complicated definition, is mutual fund is a mechanism for pooling the resources by issuing units to the investors and investing funds in securities in accordance with objectives as disclosed in the offer document. Simple terms, people with money without much knowledge collect money together, give it to an expert. Expert will invest for them. Whatever returns come proportionately are divided between simple how a mutual fund works. Now, a very good advantage of mutual fund is that your risk gets divided. You invest in one stock, but mutual fund invests in 20 stocks. One company, even if it fails miserably, it is only 5% or 6% of your portfolio, so it doesn't impact much. So that is one very good advantage of mutual funds. Then every mutual fund has different objectives, like be it growth, be it dividends, be it risk avert funds. I mean, depending on your risk profile, the fund manager will clearly describe what all are the objectives of the fund at the beginning of the fund itself. So depending on what you want, you can invest in it. Now there are some advantages, there are some disadvantages. There is no investment without any disadvantages. Investment advantages of mutual funds are firstly diversification, like we told, your money is split into many different companies. Secondly, an expert is managing. Regardless of how good you are all 30-year-old, there are people who are managing funds who have 30 years of experience. So thank you so much. So you cannot compete with them in terms of knowledge. So that is one good thing that's happening, that an expert is managing your funds. Then third is liquidity. Now liquidity is as good as it gets. Today I want my money tomorrow. Today I'll encash my fund. Tomorrow I get it. Click redeem, your money is coming next day. Click purchase, you're buying units. So that convenience is there. Then in case of shares, whatever returns you generate, you pay taxes on it. But in mutual funds, unless you redeem your mutual funds, you don't have to pay any taxes. The mutual fund gets the money, it reinvests for you. That way your money keeps growing. Affordability. Now, like we were discussing, if you have 1 crore budget, you can't even buy good real estate. But even if you have 1000 rupees, you can invest in mutual funds. So whatever your monthly any person with monthly savings of 10,000 can invest, any person with monthly savings of 10 crores can invest. So that affordability is there. Then range of options, there are thousands of mutual funds available. So depending on your risk appetite, depending on what returns you are expecting, you can choose whatever you want. Then there's transparency, like in case of stocks, there is SEBI. SEBI has a hammer on their head all the time. For mutual funds, there's a body called AMFI. So AMFI has made sure that every detail of a mutual fund is very clearly explained. So you know exactly what you're getting into. Coming to disadvantages, mutual funds are subject to market risk. So you never know the day you need money, market can collapse and you might get much lesser returns, or you might not even get your investment. So that risk is always there. Then you don't have control over your money. The advantage was that expert is investing, but that also is a disadvantage. You have no control. Your money somebody else is investing, and you cannot tell him that invest in this company. Then there's an expense ratio. Now the fund manager is not working free of cost. They have their fund house, they have their staff, they have their analysts, their accountants, their cleaning staff, their security, whatnot. So all these things are paid from your money. So redeeming your mutual fund, this is known to you by the disclosure agreement initially. Say a mutual fund says that if you take out your money within 1 year, you'll have to pay a 2% exit load. 2 years, you'll have to pay 1%. So these kinds of exit loads are charged to you, which are not there in case of direct stock investments. Then again, what was a very good advantage, that there are range of options available, is also a very big disadvantage, because there are more than 1000 funds available. So choosing the right fund itself is a very big task. So that is one major disadvantage. First is based on fund scheme. There are two types, your open-ended and close-ended. Open-ended is where a fund has started. I can invest today, I can redeem in 2 days, you can invest tomorrow, you can redeem after 1 year. It keeps going till the fund is stopped. Whenever you want, you put in money. Whenever you want, you come out of it. It is absolutely flexible. Close-ended is when the fund starts itself, there is a lock-in. They come out with the idea that this particular fund will be starting with this much corpus for say 5 years. Now 5 years, no new person will come in, no old person can go out. A lot of authority. He decides what he wants to invest in. Passively managed are like they copy indexes. I mean, there'll be a Nifty fund that replicates Nifty. So here the fund manager does not have much authority, and therefore his efforts are less, so the charges are lower here. And then the next type is assets they invest in. There are 3 types here: equity funds, debt funds, hybrid funds. Equity funds invest in equity. Debt funds invest in debt, but hybrid funds are the ones where the fund manager has a lot of flexibility. He chooses whether he wants to invest in debt, he wants to invest in equity. Now there are many funds that are even investing in startups. So these kinds of things happen only in case of flexible funds, hybrid funds. The next one is based on case of a growth fund, your money keeps compounding. You never get any money out of it till you redeem your units. Now there may be people who want passive income from their mutual funds, that every month or every quarter some money should hit my bank account for my expenses. For them, dividend fund is a very good option available. So whatever returns the fund is generating, either in full or a part of it, you get in form of dividends. So you have a continuous income from it. Then the third type is a dividend reinvestment fund. In this case, dividend comes to you, but it is reinvested. What essential dividend. So people do this for a very reason that today I am paying my taxes. When I get out of it, at that time I won't be taxed because most of the amount is already taxed. But I don't see any reason for investing in these kinds of funds. Ideally, at our age, since we are generating income from our other business avenues, we should go for growth funds and let the money compound. Now, the other way you can differentiate funds is based on the mode of investment. There are two types, direct and regular. In case you are a person who has very good knowledge, you know exactly which fund you are going to invest in, then go for a direct fund. Otherwise, go for a regular fund. Regular fund is the one where your advisor will advise you that go for this fund, but advisor doesn't charge you anything. The mutual fund pays them. So your returns get reduced from there. So if you need an advisor's help, go for a regular fund. Otherwise, go for direct fund. You will be generating marginally extra. But again, as I've been telling, whatever extra you earn without any effort is good money. So that is one option available to you. Then there are other types of funds like index funds. Index funds replicate any index, be it Nifty, be it Bank Nifty, Sensex. Then there are ETFs. ETFs are very popular in US. They are now gaining popularity here. These are basically they are mutual funds, but they are traded in the market. So it becomes very liquid. Now today, if I want to sell a stock, if I want to sell a mutual fund, it is 1 day, 2 day process. But in case of a ETF, I sell it now, a buyer buys it immediately and my money hits my account. So that is an advantage. Then ELSs are equity linked schemes. Then so you're like a ULIP, they are investing in equity for you. Then there are sectorial funds, like you are bullish on banks, you can invest. There's this SBI Banking and Financial Services Fund. You invest in it, they will only invest in banks and financial services. So that way there are sectorial funds. Then there are international funds. Now, international funds, a good one is Franklin Feeder US Opportunities Funds. What happens is your money is invested in the likes of Amazon, Google, Facebook and all. So even if there is a domestic problem, now there's a budget on 1st February, Indian stock market people are worried what will happen. But if you were invested in that stock, US does not care what our budget says. So your money is safe that way. So these are some options available for you. You have knowledge of them, that will help you big time. AUM is assets under management, basically the total amount of money that the fund is managing. I personally prefer funds for myself which have a AUM of at least 5,000 crores because it gives a confidence that they have proven themselves. Based on your risk appetite, you can choose what you like. NAV is the net assets value, so that essentially is the value at which you will be getting the units of the mutual fund. Benchmark is a comparison. Now say you've gone for a mutual fund that is dealing in all the bigger companies, large cap mutual fund. So for benchmark for that would be Nifty 50, the biggest 50 companies in the country. So they will show you that Nifty 50 has generated 18% last year, we have generated 20%. So we've given 2% better returns than what you would have got from Nifty. So that is the benchmark for them. Then transaction load, each time you buy units or you sell units as an exit load, but each time you buy units, you will be charged a very small fee for facilitating the transaction. That is known as the transaction load. Exit load is when you are exiting the fund, the charges that are levied on you. Finally, expense ratio that we spoke, whatever the charges that a mutual fund is incurring, those are charged from you. So that is the expense ratio. 3 ways to do it. First is lump sum. Today I got 1 crore rupees, I'll invest 1 crore rupees and I'll sit tight. That is known as lump sum investment. Second one is SIP, systematic investment plan. This has become very popular of late. So what happens is, say my salary day is 5th of every month. I'll put a SIP for 6th or 7th, that before I spend any money, my money should get invested. There are advantages that people talk about, that you'll get averaging. If the market falls, you get stocks at better prices. But that also becomes a disadvantage that nobody talks about. Now, I get 1 crore today. I decide to do a SIP where I will invest 10% every month, and in 10 months I will be fully invested. If the market booms in 2 months, Nifty skyrockets for whatever reason. Now, first Feb we have a budget, they come out with some extraordinary budget and Nifty goes crazy. I would have invested only first installment. So while I was sitting with 1 crore rupees, only 10 lakh will yield very good return for me. Rest 90 lakh would be sitting idle for me. So that is one disadvantage of SIP. But parallelly, the averaging advantage is there. So again, depending on your risk appetite, you can choose whether you want SIP or lump sum investment. Again, these two investment modes are known to everybody. This is something that not many people know of. SWP, Systematic Withdrawal Plan. So like I was sharing, say today I come across 1 crore rupees. I have invested lump sum or SIP. But now I decide that this 1 crore rupees, I want to give it to my son 10 years later. So there's one very good thing that I can do, that 1 crore rupees I put in a SWP and I do it in a very safe debt fund that is giving me 12% returns. And I have put a condition there, every month I want 1 lakh rupees. Systematic withdrawal. So every month I am getting 1 lakh. So what is happening? My 10 crores is generating 12 lakh rupees every year. I am taking out 12 lakh rupees every year. End of 10 years, I have taken out 1 lakh rupees every month and I am still left with the 10 crore rupees corpus. So this is a very good advantage of SWP. Again, for people who need passive income, this is a very good option. If you have other incomes, you don't need it, ignore SWP terminology. So this right now, as you all are aware, stock market is the flavor of the season. People have seen crazy bull run. Everybody likes to talk about it. You invest or not, you want to know about it. So that was the reason I thought I'll cover this. Here we'll be discussing about all the terms used in stock market. Knowing these terms, you will not feel lost out. Simple. So to start with, capital gains. Capital gains is the tax that is put on you whenever you sell your shares. If you've sold within 1 year, you are charged short-term capital gains, that is 20%. If you sell after 1 year, you are charged long-term capital gains, that is 12.5%. Dividend is the company's way of rewarding you. Whatever profits they make, they want you to earn some money. A part of it is given in form of dividend. Dividend is taxed as per your tax slabs. Face value. Now, a stock after listing can go anywhere. When it was listed at 100 rupees, it can go to 1000 rupees. So that is based on market conditions and all. But face value essentially is what the stock was priced at. Now, ideally, a stock initially is worth 10 rupees. Whatever dividends you get are on face value. So it is good to know what face value is. And whenever they split it, it goes from 10 to, it can go to 5, 2 or 1. Those are the face values available in the market. Top line and bottom line. Top line is your turnover. Bottom line is the profit that the company is making. Stock split. Now, a company stock keeps going up. Say it's gone from 1000 to 10,000. There would be many people in the market who don't afford a stock worth 10,000. So just to get the liquidity, one of the good way to do it is split the stock. Stock's face value is 10 rupees. It can be reduced by a corporate action to 1 rupee. So you are splitting the stock from 10 to 1. And say you had 10 stocks, 10,000 rupees worth of 10 stocks, you will have 100 stocks worth 1,000 each. So you won't see any difference in your wealth, but liquidity would increase and slowly the stock would start picking up even more. Another way to do this is by issuing bonus shares. Same thing happens. Say a company is giving 10 to 1 bonus. So for per stock, you get 10 stocks. 10,000 worth of stock becomes 1,000. But here the face value will not change. That is the only difference. Primary markets are IPO. When a company is coming out with the IPO, they do it through the primary market. Secondary market is your exchanges, NSE, BSE, where stocks are traded. IPO is where the stock is traded from promoter to the retailers or all the market participants. And secondary is where market participants exchange stocks among themselves. Then your demat account. Previously, as you all are aware, stocks used to be in physical form. They have been dematerialized. So the account which holds them is known as your demat account. Then types of investors, it has been divided based on the amount that is being invested. Say a IPO is coming out. If you are investing anything less than 2 lakh, you are considered to be a retail investor. If you are investing between 2 lakh to 10 lakh, then you are a small HNI. If you are investing anything above 10 lakh rupees, then you are a big HNI. And the allocation also is done separately for each of them. And then there are DIIs. DIIs are domestic institutions like mutual funds or LIC or any other institution that uses public money to invest in the markets. FIIs are foreign institutional investors, same thing, DIIs of abroad. And FPIs are foreign portfolio investors. Like we were discussing about AIF, PMFs. So for the foreigners who are doing these are considered as our FPIs. Then depositories. Depositories are the companies who will convert your physical shares to digital shares. There are only two, CDSL and NSDL. Then depository participant or DP. This is your broker, Zerodha, Grow, HDFC Securities, Kotak, whatever you are using. Then opening a demat account, it is as simple as it gets. All you need is one PAN card, your address proof, a cancelled check or bank statement and a photograph. That's it, and your demat can be opened within 30 to 45 minutes. Then contract note. So there's a rule from SEBI that whatever transactions you do have to be reported by the broker to you within 24 hours. Otherwise, they are charged a penalty very heavily. So those transactions are sent to you by a document, either by post or by email, whatever you've selected. The document that comes to you for this is known as a contract note. Then settlement date. Settlement date is when you will get the stocks that you buy or when those stocks would be delivered when you sell it. Up to few months ago, it was T+2. So today if I sell a stock, after 2 days it would go from my demat. Now it is T+1, and soon all the brokers are working on getting it to T+0. So today I buy it, today itself it will be delivered. Then pre-market hours, pre-opening market hours. Market is open from 9:15 to 3:30, but there is a pre-market hours of 9 o'clock to 9:15. 9 to 9:07 you place orders, 9:07 to 9:10 they map it with buyers and sellers, and up by 9:12 the mapping is done, and 9:15 regular market opens. Gap up, gap down. Now today if a stock has closed at 1,000 rupees, 99% chances are there that it will not open at 1,000 rupees tomorrow. It might open at 995, it might open at 1,005 or whatever. So if it is opening at a higher level than today, then it is known as gap up. If it is opening at a lower level, it is known as gap down. Pretty simple. Announcement date. So we were talking about the splits and bonuses. Whenever the companies announce this, that date is known as announcement date. Then there is a record date and ex-bonus date. Record date is the date if you are holding the shares on that date, then you are eligible for the bonus or dividend or the split that is happening. Ex-bonus date is that now if a company has announced 10 rupees dividend, then once that 10 rupee comes, it has come out of the company. So the stock value is adjusted by 10 rupees. So the day that happens is known as your ex-bonus date. Corporate actions are again these things only, the dividends, the bonuses, the splits that happen. Then the types of orders. Now there are a couple of types of orders that you can place while you are buying or selling. First is a limit order. Say a stock is trading at 1,000 rupees. I decide that I want to buy it at 995. I'll put a limit order for 995 rupees. Over the course of today, if the stock comes to 995, I get the stock. Otherwise, at 3:30, my order is cancelled. Market order is if I decide that I want this stock at any cost. I put a market order, say it is at 1,000. Even if a seller is sitting at 1,010 rupees, the order gets executed at 1,010 rupees. Then there's a stop loss order. Say I have bought a stock at 1,000 rupees. Now it has gone to 1,100 rupees. I decide that I want to enjoy the upside, but I don't want the profit to go away. I want at least 50 rupees from the stock. So I'll put a stop loss order at 1,050. Now what happens is if the stock goes from 1,100 to 1,200, 1,500, 2,000, 10,000, I don't care. I am getting that profit. But the moment it hits 1,050, my shares are sold. So 50 rupees profit at least I have got from it. Then there's an order called IOC, immediate or cancel. So like I was sharing, I put a limit order for 990, but that is there till 3:30. Now if I don't want that kind of a thing, I put a IOC order. I put an order at 990. Immediately if there is a seller at 990, my order gets triggered. Otherwise the order gets cancelled. Then whatever orders I just spoke about are all valid only for one day. There are options like GTC and GTD which have longer validity. So there's a stock trading at 1,000. I want it at 990 rupees. If I put a GTC order, GTC means good till cancelled, and I leave it. In 10 days also if it doesn't come, my order will be there. The day I decide that okay, it is not coming, I cancel it, I can cancel it, it gets cancelled. GTD on the other hand, like today is 17th, I decide that I want to buy this stock for 990 rupees, but in next 10 days if I get it, I'll take it. So I put the date as 27th. So by 27th, if any day the stock hits 990, I will get the stock. Otherwise the order will get cancelled on 27th. Stock will go up, you are bullish on it. If you think that a stock will go down, you are bearish. So the reason behind this. Now, if you know, a bull always hits up with his head. A bear always hits you with its palm down. So that was the logic behind it, that going down is bearish, going up is bullish. Then short sell. Now there's a stock, again it is trading at 1,000 rupees. I don't have the stock, but I feel that it is going to go at 990. So there is this option available for me that I can short it, but that is only valid for intraday in equity markets. and at the end of the day I have to square it off. That is known as a short sale. Now there's a term called shares auction. Now I have shorted a stock. Unfortunately, that stock zoomed away. There is something known as a circuit filler. I should have put it before shares auction. So circuit filler essentially is to bring some sanity to the market. Today some news has broken. Lotus chocolate being acquired by Reliance. I will buy it at any price. But the value of Lotus is the value of Lotus. Just because Reliance is buying, it should not go 100 times. So that is why there is a circuit filter in place. For a particular stock, let's say a circuit filter is 10%. It is at 1000. So the highest it will trade at today is 1100, lowest is 900. The moment the price hits 1100 and there are, we cannot buy it at a higher price. So say I have shorted a stock and it has hit a upper circuit. Now when I have shorted, somebody has bought it. So I have to give delivery, but I don't have the shares. So in this case, there is an auction that happens after market hours. Retail participants are not permitted to participate in it directly. Brokers do it, and on behalf of the clients, they'll do it. And the shares traded in this auction trade at a premium. So when you're shorting stocks, be very careful. Now the next point is stop loss. We've already discussed stop loss. Circuit filter also I've just shared. Trend analysis. Trend analysis is doing technical analysis to determine whether you are bullish or bearish, or neutral. So if you think that market will not go anywhere, you think that there's a neutral trend. And market capitalization is the total valuation of a stock. Number of free float shares multiplied by the price of the stock is the market cap of a company. Ring trading. Ring trading is a type of a Ponzi scheme. Now a company is worth 1000 rupees. I buy it for 1050. I tell Dheeraj he'll buy it for 1100. Aditya will buy for 1200. Ravnik will buy for 1300. Vikas will buy for 1400. Mohit will buy for 1500. By then there will be a buzz created that this stock has gone 50% up within a month. Something great is going on. Then retail people start coming in and they invest their money. It goes to 2000 rupees. We decide let's exit. Now poor retail people have bought it for 2000, but the value was 1000 only. So it is bound to crash. That way we've trapped retailers. So that is known as ring trading. It is illegal. Never do it. Yeah. So next, the next term is block deal. Block deal is when minimum 5 lakh shares or 5 crores worth of shares are transacted in a transaction. Bulk deal is when minimum half percentage of a company worth of shares are transacted. Essentially, bulk deal and block deal is done by promoters. Retailers ideally don't do this big transactions. Then what are the indices? There's Nifty. Nifty is top 50 companies of India. Bank Nifty is the top banks of India. Fin Nifty is banks and financial companies. For instance, Bajaj Finance. Now it will not be a part of Bank Nifty, but it would be in Fin Nifty. While banks would be a part of both of them. Then Sensex. Sensex is BSE's version of Nifty. Top 30 companies of India. BankX is top banks in Sensex. Then there's Nifty small cap, Nifty mid cap. So there are many such indices available. Then there are world indices. Nikkei is Japan's index, Hang Seng is Hong Kong index, DAX is Germany's index, CAC is French index, NASDAQ is the IT companies of USA, S&P 500 is top 500 companies of USA, Dow Jones is also an index of USA. It is a hopeless index. I don't know why they are running it. So Nifty or any index that you see, there's weighted average. Now HDFC is the top company, Reliance is the second biggest company, they have bigger weightage. So same thing is followed in S&P, but in Dow Jones they have given equal weightage to everything. So even if a stupid company is falling, the entire index falls. So that is, I don't know why they are running it also. Then promoters pledging shares. Now you are a promoter of the company, you hold a good chunk of shares. Instead of selling them, if you are pledging them, that is known as a promoter pledging of shares. Lot size is the size of shares or fund or whatever instrument you choose in the multiples of which you can sell. In India, lot size for stocks is 1. Be it a 5 paisa stock, be it LCD or MRF or Page Industry trading in thousands and lakhs of rupees, still you can trade in multiples of 1. In US, you have a provision to trade in fractions. You can buy 0.002% of Google. But in India, you cannot buy in fractions. You'll have to trade in lots of 1, multiples of 1. Then finally, merchant banker. Merchant banker is your one-point contact for IPO. You want to take out your IPO, merchant banker is the guy you want to go to. It's difficult. Once you understand it, it is as simple as it gets. So feel free to ask me whenever you have any query about it. Firstly, there are two types of derivatives, futures and options. Futures, what futures means? Now today, if a stock is trading at 1000 rupees, market as a whole thinks that on expiry, let's consider next month expiry, February expiry is the day the future would expire. Basically, you will have to give delivery or take delivery of the shares. So if market participants have determined the price to be 1040 rupees, very bullish on it, you think that it would go to 1050, 60, then you buy the future. So why you do derivatives is that in case of a stock, if you want to buy 1000 rupees worth of stock, you have to pay 1000 rupees. In case of derivatives in futures, the margin, you have to pay a margin, that is 20% of the value. So to buy 1000 rupees worth of stock, you have to pay only 200 rupees. So you think that it will go to 1060, you bought the future at 1040. If you were right, it goes to 1060. Now in case of stocks, you would have invested 1000 rupees, 1040 rupees, and you made 1000 rupees, you made 60 rupees, 6% ROI. But here, no doubt you paid 1040. So you paid higher, but you paid only 20%. So on 200 rupees, you make 20 rupees, that is a 10% ROI. So that way your returns fluctuate big time. The same thing can happen on the opposite side also, so that risk is always there. And similar to futures is options. Now 1000 rupees, a future will trade only at one value, be it 1040. But options are available at every price point. For a 1000 rupees stock, options would be ranging from 1010, 1020, 1030, 1040 all the way to 1250 or so. Same time it would be 990, 980, 970 and so on till say 750 or so. So now if I am very bullish on a stock, in case of options, you can buy options, you can sell options. There are again two types, a call option and a put option. I mean the next two slides are for call option and put option, so I'll try to explain better there. Now there is just one tip that I wanted to share, not a stock tip. So if you plan on doing derivative trading in stocks, try to go for dividend paying stocks. High dividend paying stocks are usually more stable, and as an option seller you want stability in the market, so it would help you a little. Then I was talking that about margins, that you have to pay margins. So here what happens is, in case of buying equity, if I want 1000 rupees worth of stock, I have to pay 1000 rupees hard cash. But in case of options, you don't have to pay cash. There are two components, cash component and collateral margin. Cash component is if you directly put cash or you buy some cash component of mutual funds, like there are some liquid funds or overnight funds which are absolutely safe. The broker knows that this will not go down, so that is treated as cash and you get 95-94% margin against it. The second option is collateral margin. You pledge your equity or you pledge your mutual funds, against that your broker will give you margin. You can use that to trade. Now the biggest advantage here is, let's say there is one person who's only investing. I am trading in options also. Now as an investor, if let us just consider Nifty, you have also bought only Nifty, I have also bought Nifty, but I am parallelly trading with it. As an investor, you generated 18%. I have generated the same thing, but I have pledged them and I have generated 20% from derivatives. Now what has happened is, your wealth has gone up by 18%. Mine has gone up by 38%. That 20% extra I am able to generate. So even if I am generating less money from derivatives, I am not using my money, I am using my margin. So there are two ways I am making money. That is a very big advantage here. Now there are, again in options there are two types, European and American. You don't need, this is not useful anywhere, but for knowledge sharing I thought I'll just share. In India we use European options, that is why we write them as CE, PE. CE means call European, PE is put European. Difference is that, like I was telling, that on expiry you will have to give or take delivery. In European options, the option will be valid till expiry. After expiry, delivery has to be given or taken. In case of American options, nobody uses them, even America doesn't use it anymore. In case of American options, a buyer can demand delivery anytime. So that's a risk on the seller, for which they charge extra premium also, but just for knowledge sake. Now what any builders here, Rakshit for instance, let's say he's come out with a project. He's selling a plot for 1 crore rupees. I think that in 2 months, I know that probably a highway is coming there or something that is not known to anybody. Or whatever reason, I think that it is going to appreciate big time. I feel that the plot will sell at 1.5 crores in 2 months. Now what can I do? I can go to Rakshit, I can tell him, this is your 1 crore rupees, give me the plot. But here what is the problem for me? One is that I am shelling out 1 crore rupees. Second is if my view goes wrong and it goes to 90 lakh rupees, ek to I have lost that, I have lost 10 lakh rupees. Secondly, I don't know now when I will get a buyer to buy that plot. So I am stuck with 90 lakh worth of inventory. So to mitigate this, I go to him, I tell him that boss, this 10, I am giving you 10 lakh rupees. You don't have to return it to me, you don't have to adjust it anywhere. This is a premium I am paying you, for which for 2 months you hold the price for me. After 2 months, I'll either come and take it at 1 crore. At that time, even if it is trading at 1000 crores, you have to give it to me at 1 crore. Otherwise, I'll tell you, sorry, you keep the 10 lakh rupees and you don't even have to adjust that. At that time, I will pay you full 1 crore once again. This 10 lakh is all yours. So that way I have locked the price. Now, if you see from my point of view as a buyer, I have paid only 10 lakh rupees for something that is worth 1 crore. If my view goes correct and it goes to 1.5 crore, then as against spending 1 crore and generating 50% ROI, I have spent 10 lakh rupees and 1.5 crore, so that is 40 lakh profit. Against generating 50% ROI, I have generated a 400% ROI. If my view goes wrong, then I am not stuck with a property worth 90 lakh rupees. Parallelly, I have only lost 10 lakh rupees. Seeing from the seller's point of view, now he has not done any favor to me. He was anyway selling it for 1 crore rupees. Instead, let's say his costing was 80 lakh rupees. He was taking a 20% profit and selling at 100. Now he's got further 10% from me. So for him it is a win-win. Now after 2 months, if it is trading at 150 or 1.5 crores also, he doesn't care because he was anyways willing to sell at 1 crore. So that is the entire modus operandi behind call options. Now if we talk the same thing in stocks, let's say a stock is trading at 1000 rupees. I am very bullish about the stock. I think it will go to 1050 rupees. The call option of the stock is trading at 1010 rupees call option of a stock, or 1000 call itself, let's take the same price, is trading at 10 rupees. I will buy the option at 10 rupees. At expiry, if the stock goes to 1050, I make 40 rupees. If it goes to 1100, I make 90 rupees. It goes anywhere, I keep making money, and if it goes down, I lose only 10 rupees because that was my premium paid. So as an option buyer, my profit is unlimited, but my loss is capped to the premium I paid. But as an option seller, if the price goes beyond 1050, he has sold 1000 rupees call option, he's taken 10 rupees premium. So his costing essentially has become 1010. So if the stock expires below 1000, I will not take delivery. I mean, I'm getting it in free market at 1000. Why would I take from somebody at 1000? So the premium is his. Secondly, now as a seller, but if it goes higher, then the loss is unlimited. It goes to 2000 rupees. You still have to give it at 1000. So you are selling a stock worth 2000 for 1000 rupees. So your risk is not capped, while your profit, even if the stock goes to 600 rupees, I have taken as a seller only 10 rupees. So I have lost 400 rupees in stock value, but I got only 10 rupees. So how it works is, as an option seller, your profit is capped, but your loss is unlimited. As an option buyer, your profit is unlimited, but your loss is capped. But all is not good for option buyers also. Now what happens is, an option buyer does not afford to be wrong. Option seller, up to some extent, affords to be wrong. Now I'll tell you why. Firstly, I just want to share some jargons again. Whatever we were discussing, if we see the same thing, now this is the 1000 rupees stock. X is the strike price. Strike price means the price at which you've sold or bought the option. 10 rupees we've taken, so the break even is 1010. Now if I have sold a 1000 rupees call option for 10 rupees, if it is anywhere below 1000, it may be 800, 700, 500, whatever. My stock loss is different, but my option will give me that 10 rupees profit consistently. If it starts going up, then 1000 is my strike. If it goes to 1002, then I have to, basically I've got 10 rupees of which 2 rupees are gone. So my profit is 8. That way at 1010 my break even is hit. So this is my break even point. Beyond that, whatever it goes is my loss. So strike price is the price at which you've sold. 1000 rupees in this case is the strike price. Underlying is the price of the stock currently. In this case, since I've spoken about selling the same price, underlying would also be the same. Expiry is the expiry date on which it expires. For a February stock, it would be 20. So expiry is for Nifty or NSE options, expiry is last Thursday of every month. So 26th Feb is the last Thursday of next month, so it would expire that day. Then premium is the price that a buyer pays to the seller. Now there is something known as moneyness of an option. Moneyness means there are three things in this: ITM, OTM, ATM. ATM means at the money. So this is the strike I have sold, say 1000. So 2 strikes below or 3 strikes below, 970 to 1030 are at the money strikes. Anything beyond this, if the option seller is not losing money, then it is OTM, out of the money strike, because he doesn't have to pay money. Anything below this, since the option seller will end up paying money, it is considered as in the money option. So that is known as a ITM option. Now this is a call option. Exact opposite of it is a put option. In case of a put option, when say again the stock is trading at 1000 rupees, a person feels that it will go to 950 rupees by Feb end. So say the 1000 rupees put option itself is trading at 10 rupees. Same thing, I will buy a 1000 rupees put option paying 10 rupees. The assumption behind this is that if it goes to 950, my costing was 10 rupees, I have made 40 rupees, my ROI is 400%. This is exact reverse of a call option. So if I am explaining you the payoff chart, this is the strike price, 1000 rupees, we've sold a put option here. So as an option seller, let it go to 1010, 1020, 5000, wherever. I have taken only 10 rupees. So my profit would be only 10 rupees. It is capped at 10 rupees. But as it starts going down, at 990, my break even is hit. Beyond that, how much ever it falls, I will have to pay the buyer. So this is how the payoff chart of a put option seller works. All seems rosy for a buyer only, but it is not. And me or any good option trader is a option seller only. I'll tell you why. Now we've been seeing that he is paying only 10 rupees, but he's made 90 rupees, he's made 100 rupees. But what we have to see is that the probability of making profit. In the market, there are 5 scenarios that can happen. Your view can go absolutely correct. It can go partly correct. It cannot go correct or wrong. It can go partly wrong. It can go absolutely wrong. In case of an option buyer, now if his view was that a 1000 rupee stock will go to 950. So basically he thought that the price would go down. Now if he goes absolutely wrong, the stock zooms up. It goes to 1100. He's lost all his money because the stock did not go to 990. If his view goes partly wrong and it has gone to 1020, just barely moved up, still he loses the entire money. If the view goes nowhere and the stock stays at 1000, still he's paid 10 rupees which is gone, so he's still a loser. Now even if the put option buyer is correct and the stock has gone down, but it has gone down only 5 rupees. He has paid me 10 rupees, but the stock has gone only 5 rupees, so still he is losing 5 rupees. So the only scenario where the option buyer makes money out of the 5 scenarios is when he's absolutely correct and the stock tanks, or in case of a call option, it zooms up. So that is why option buying is to be avoided unless you are a very, very strong technical analyst. Guys, did you understand? She bought it, she sold, he bought. So all those transactions happen. End of the day when the expiry comes, you had bought, you had sold, you are out of it, nothing to do with you. But we both are remaining. Like this, many people are remaining. What the exchange does it, remaining buy orders and sell orders are all mapped with each other. And then depending on the buyer and seller, deliveries happen. So here also there's say you have bought a call option for 1000 stock at 10 rupees. Stock has gone to 1050. The same example that we shared. At the expiry, and the stock has gone to 1020 rupees. So you have an option. I don't. If you demand delivery, I have to give you shares. You have 2 options. Either you will take shares from me at 1000 rupees because that was our agreement, or I will have to pay that 10 rupees difference to you. Now this happens at the money. I will not get too much in detail, it will confuse everyone. But if you are trading in at the money call options, then delivery is buyer's choice. If it is out of money, then out of money means seller is correct. So the 1000 rupee stock is now trading at 990. you would not want to take the stock from me at 1000 rupees, so there is no question of delivery. If it is in the money, that is 3 strikes away from the strike, then you mandatorily have to take delivery, I mandatorily have to give you delivery.
Yeah, so I'm bullish about the stock and I think it will touch 150 in the next Thursday, next month's Thursday. So instead of buying a call option today, you are saying sell a put option.
Correct.
That's right?
Correct. I'll tell you the logic also. Even if you go wrong, 1000 rupees stock, you've taken a premium of 10 rupees by selling a put. Even if your view is wrong, stock does not go up. It goes 5 rupees down. In case of call option, your money is gone, buying call option. But in case of put option, you had taken 10 rupees, but the stock has corrected 5 rupees. So still you come out with 5 rupees profit. So in case of buying, your profit is extraordinary. But your probability of making profit is very low. In case of option selling, your profit is very limited, but the probability to make profit is very high. As a business, selling is good. In your own business, now you are into biscuits, you will not expect that every month you get 1000% ROI. You will work on whatever margin you work on. So same thing works in case of options also. You want 2-3%, it is sustainable. You want jackpot every month, एक बार market will give you one third and wipe you away from the market. Straight, simple thing. So option buying is only possible profitably if you are a very good good technical analyst. Okay, something, so many people ask me for tips, I'll tell once, now I'll explain you some derivative strategies, then I'll tell you something. So what I do, as you can see, there are multiple strikes. At every strike there is one particular premium. The closer you are, more premium, because premium is also proportional to your risk. So this is how it works. OI change, OI and all, leave it for now. All you have to focus is what are the strike prices, what is the premium. Theta is time value. Every day that is passing by, time value of the option is decreasing because the risk is coming down. So that is calculated using theta. VIX is volatility index or the risk index or the fear index. So as and when there is an event coming, VIX will go up, that will spike the premiums. Vega is a Greek of Greek. Basically, how your premium will change with respect to VIX is calculated using Vega. Gamma also is a Greek of Greek. It tells you how your delta will vary with respect to the change in price. I will not go in depth here. It will confuse you all big time. Yeah, most welcome. So yeah, now I want to share just 6 very simple strategies. So first I thought that I'll make a presentation, I'll put the charts here and show it. But then I thought it would be even better if I do it using your own stocks, so choice of your stocks. So there's this covered call. I'll just give a quick brief, then we'll practically see what happens. A covered call is when you have a stock, you want to sell it, there is a better way to generate money. I'll show that. Then there's something known as a cash secured put. Cash secured put is when you want to buy a stock, instead of buying it right away, how you can make more money. I'll show that to you. Straddles, or actually let me just get into the trading portal now. If you can suggest me any stock of your choice. So this is sensible. There are 2 softwares that I am aware of. There may be others also. There's one known as Opstra. Opstra is a standalone software where you can check all your derivatives. Sensible is better than that for very reason that it gets linked to your broker and any orders you place here gets placed in real time with your broker. So if you can suggest me any stock, we'll start some examples. HDFC Bank, the biggest company in India. So let's go with it. Now I'm going to give you a few scenarios. Anybody, let's say Aditya is there. He is holding, HDFC has lot size of 550. So whatever trading you do, it has to happen in multiples of 550. Let's say Aditya has 5,500 shares of HDFC. Today HDFC is trading around 1640. Say he has purchased it at 1400 rupees. Now he wants to sell it at 1700 rupees. So what the simple thing to do is wait. Once it touches 1700, sell it. But I'll give a much better way. You can never make a loss in this. There will be a loss of your equity, but that you are anyways holding in worst case. I'll just show it to you. So 1700, Aditya wants to sell it at 1700. So in this case, underlying is the current price 1640. The strike price would be the option which he wants to sell, 1700 rupees. Let us go with January expiry. Last Thursday of January is 30th of January. So all these options expire on 30th January. This is the option chain that I was telling you about. These are the strikes, and implied volatility, IV is implied volatility, leave it for now. Delta, again leave it for now. All you have to focus is the put price and the call price. Now he wants to sell it at 1700. Instead of waiting for 1700, if he is selling 1700 call option, this is 550, he has 5500 shares, so I'll just add that. Now what has happened? I had shown you the payoff chart as a options. I'll just zoom it out 1 second. So right now Aditya is a option seller because he has sold the call options. This is his payoff chart. Current price is 1640. 1700 is his strike price. 1700 plus what is the premium he's got? 9 rupees 65 paisa. So 1700 plus 965, 17965 would be his break even, rounded to 1710. So here what exactly has happened? Let me try to explain it to you. What are the possible scenarios? Scenario 1 is the stock tanked. Instead of going from 1640 to 1700, it has gone to 1600 or it has gone to 1500. Aditya has taken 5500 quantity into 9 rupees 65 paisa. He has taken 53,000 rupees as premium. Since the option never went in the money, the buyer will not get anything. So this 50,000 is in his pocket. He will have a very big loss in his equity because his shares of 1640 have gone to 1500. So that 140 or whatever rupees into 5500 would be his loss. But why I am telling this is loss proof or this is fail safe is that he was anyways holding that equity. That loss he would any which ways have. But here the advantage is that he is generating 53,000 extra. So if the view goes wrong, the option expired worthless, he gets 53,000. If the stock remains as it is, it doesn't go anywhere, then stock is still at 1640, it has never gone in the money, he doesn't lose anything on the stock. Parallelly, he's made this 53,000 rupees. Next month again he can choose to sell the same call option, again he'll get 50,000. So with your holdings, whatever appreciation you get, you are parallelly generating extra income, and that income is how much? The margin that he's blocked for this trade is 23 lakh rupees, for which his profit is 53,000. That works out to be 4%. So 4% per year, per month, not even 1 month. Today is 17th, this option expires on 30th. In 13 days, that is extraordinary. And the best part is that this 23 lakh rupees also he does not have to pay. He can pledge his shares and the margin can come from there. So whatever his stock appreciation is there, this 4% is extra profit that he's got. Now his view can go wrong. Go wrong as in the stock can go to 1750, 1780. Now what happens is, see, if you see here, till 1700 nothing, he's getting full money. But after 1700, the break even is at 1710. So till here he'll make 20, if it expires at 1706, he'll make 20,000. So that way it reduces. Say the stock zoomed away. It's gone to what, 18,000. So now what happens at 1800? Now what happens is that, like I told you, profit is limited, capped at 53, but loss is unlimited. On expiry, his loss is 4,97,000 rupees. So basically, either he pays this 4,97,000 rupees and closes the trade, or he has to give delivery of a stock worth 1800 at 1700 rupees. So in either case, he is losing. But if you see from his point of view, these 5,500 shares he is any which way is holding. So while his loss is 4,97,000 rupees, in his equity, which is now trading at 16, so he's lost 100 rupees here per unit, but he's made 160 rupees in his equity. So still he's gained 60 rupees. So what he was ready to sell at 1700, he's got assured 53,000 plus he's got additional 10 rupees buffer, and then he's selling it after 1 month. So that is one very big advantage that you get from covered call. Don't do this if you do not have equity. If you know how to manage your positions, nothing like it. If you don't, then do it only for equity that you have, because you cannot predict the market. There are only two people who can be correct in stock markets all the time. One is God, second is a liar.
Third is Ashish.
No, Nobody. Everyone goes wrong. It happens. See, if I am more experienced, probably I will be wrong 20% times. You are not experienced, you may be wrong 50% times. That difference might be there, but at any point of time, everybody will be wrong. So, if you have equity, you are not at all bothered. If it is going down, you are getting extra money. If it is going up, you are giving your shares. You are anyways ready to book profit. So, do this only if you have equity. So, this is known as a covered call. Covered call means you are covering, your call is covered by your equity. Cash secured put that I had mentioned. So, this is again the exact reverse. Say, I'll take Aditya only. Aditya does not have HDFC equity. Today it is trading at 1600 rupees. He wants to buy it, but he wants to buy it at 1600 rupees. So what he can do is, I'll just clear this. I'm reversing it. So this is the 1600 strike. If he sells a put option at 1600 rupees. Again, he wants 5500 shares, so I'll multiply it there. So this is what has happened. The put option payoff chart that we've discussed. As long as it is higher, you make a stable profit. Once it starts going down, you make unlimited losses. So now I'll explain what exactly has happened here. Today the stock is trading at 1640 rupees. He wants to buy it at 1600 rupees. Instead of waiting for 1600, he has sold put options at 1600, for which he has received a premium of 15.55 rupees. 15.55 multiplied by 5500 quantity is 85,000 rupees. So his margin is blocked 23 lakh rupees, again which he can generate by pledging his other equity, against which he is getting a solid return of 7% within 13 days. One scenario, the stock goes higher. What will happen? This 85,000 he pocketed. Next month again he can sell the same call option, same put option. If it doesn't go down, he'll pocket more money. If it goes down, he was anyways willing to buy the stock. Second thing that can happen is that it goes down. Now, if it is going down, what will happen? Say the stock has gone down to 1500 rupees. Today 1640 stock. Now, Now what happens? As we've discussed, the loss is unlimited. While he was going to make 85,000, now he is going to pay 4,64,000. But the advantage here is that instead of squaring it off, if he holds it, the deal was never that I will pay you the losses. Deal was that I will buy your equity no matter where it goes at 1600 rupees, which he was anyways willing to buy. So he can take delivery. In that case, this 85,000 is pocketed, but he gets a 1500 rupees worth of stock at 1600. It seems like a loss, but when you look at it from other perspective, he was willing to buy it at 1600. So he's still getting it at 1600. At the same time, he's pocketed 85,000 rupees free of cost without any effort. So this is known as a cash secured put. Cash secured put as in you are selling a put option, you have sufficient cash to buy the equity for the option that you are selling. So these are the two simplest things that you can do. In case of call, only sell it if you have equity. It becomes a loss-proof strategy. In case of a cash secured put, only do it if you are willing to take delivery. It becomes a fail-proof. In either case, you will only come out with money. So these are two as simple as it gets, simplest strategies. Now he has another situation. Let's say he has equity. He is ready that today I am ready to buy the stock. I am ready to sell it also. If I have purchased it at 1400, I am still sitting in 200 rupees profit. I don't mind selling it, I don't mind buying it. So there is one very good thing that he can do. This is known as a straddle. Straddle is, now the stock is trading at 1640. What he can do is he can sell put option, he can sell call option. Both the things at the strike price he will sell it. Now, and again I'm going for 10 lots. There is one very big advantage of doing this. The advantage is that when you are selling both of them, you are essentially hedging one position with another position. So while you were selling 10 lots, you were paying 23 lakh rupees margin. While you were selling 10 lots of call, you were paying 23 lakh. There's something wrong. But yeah, in case you are selling, probably it is adjusting with my existing positions also. But in case you are selling a put option, you are losing 23 lakh margin. Same thing in case of a call option. Then when you sell both, you don't spend 46 lakh, rather you would be spending around 30 lakh rupees because both of the position hedge each other. Now Aditya is ready to buy stocks, he is ready to give stocks delivery. If he does that, this is a jackpot that he'll be creating for himself. His margin blocked is 23 lakh rupees. Best case scenario, if the stock doesn't move, then his put option also is paying him, his call option is also paying him. He comes out with 3,30,000 rupees for a margin blocked of 23 lakh rupees, that is 20% return on investment in 13 days. If his view goes wrong, there's a very big buffer that he is getting because he's taken premium from both the sides. If the stock goes down by 3.5%, that is to 1580, he will still be break even. On the upper side, if it goes from 1640 to 1700, still he's taken enough premium, so he'll still not make any losses. So that is the range he's got. Now what is the wrong thing that can happen? The stock goes above, beyond his break even. Let's say the stock goes to, his break even is 1700, say the stock goes to 1800. So as against his profit of 3 lakh, now he's sitting with a loss of 5,40,000 rupees. So here what has happened, his put option sold is giving him full profit because the stock didn't go down. But his call option sold, which was sold at 1640, is now 140 rupees in the money. So that is giving him loss. But Aditya is sitting on the stocks. He is willing to give delivery. So the same thing applies here. While his option is giving him 5 lakh rupees loss, his equity is gone from 1640 to 1800, 160 into 5500. His equity has given him more than 8 lakh rupees profit. So he's not made a loss, he's still come out of it with profit. Other situation, his stock has gone down to 1500 rupees. Now in this case, again, his profit was 3 lakh, but rather than that, he's made a loss of 4,38,000. Like we told, he was anyways prepared to take delivery. So he'll execute the call, his call option will give him full money. He'll execute the put option. He will buy the stocks at 1600, which he was any which ways ready. So he doesn't have to pay anything. So whether the stock stays, if the ideal scenario is stock doesn't move, you make a jackpot. Wherever it goes, since you are ready to buy or you are ready to give, you never make a loss. This particular thing is known as a straddle. Now say Aditya doesn't want to take this kind of a risk. There's another provision available where he can hedge by buying the stocks. So what, let's say 1640 is what he sold the put and call. He says that I don't want to take risk beyond 1500. If it goes beyond 1500, I want to be safe. So same quantity of puts he'll buy at 1500. Same quantity of calls, and upper side he wants it to be capped at 1800. Same quantity of calls he'll buy at 1800. Now what happens is, the same chart is there, but after one particular point, because his buy position will nullify his sell position, he will not make any losses, any further losses. So his losses get capped. And another advantage is that here you are hedging the position fully, so margin even further reduces. So in this case what happens, everything is the same, but his loss after one particular point, after 1800, his loss will not increase. And same way he was ready to give delivery or take delivery. So he'll get further advantage of capped losses and prices at which he wants delivery. This is known as a iron fly. Now this is something for a person who wants to take risk. You are someone who don't at all want to take risk, then there is a much safer way available. I'll continue with the same stock. Now it is trading at 1650. Say Aditya says that I want to sell it at 1750 and I am ready to buy it at 1500. Between that I don't want to do anything. Very, very good deal. No? At 1640 the stock is trading. You are ready to buy it at 1500, you are ready to sell it at 1700. So what he can do is he can sell a 1500 put option. He can sell a 1700 call option. Now what he's done is, he's made this spread. This is known as a short triangle. Here, as long as the stock trades between his 1500 and 1700 range, he comes out with a good profit. In this case, on 23 lakh, he's coming out with 64,000, which is 4% profit. So if the stock moves less than in his range, he's without any effort, he's making 4% ROI within 2 weeks. If it goes beyond 1712, again, like we were discussing the previous scenarios, he has to give delivery of shares, or if it goes below his lower break even of 1488, he'll buy the shares. Advantage is that he's getting the stock as 10% discount. Parallelly, he's making this return. So this is known as a short strangle, and hedging this on both the sides by buying options. Again, he doesn't want his loss to go more. He'll buy a put option here. He'll buy a call option here. So that makes his losses capped at these values. So I've taken different distances so you can see different strikes, but he cannot make more loss than this, and he cannot make more loss here. This particular strategy is known as a iron condor. So yeah, these are simple 6 strategies that I wanted to share with you all. Now same thing, I'll just, any of you follow markets? Nifty ka you have knowledge, where Nifty is trading, what, okay, so let me open Nifty, the main index of India. Today Nifty is trading at 23,000 rupees. Vikas, since you told you have some knowledge, tell me, where do you think it might expire in February? Any range that you think of? anyone who trades, 1% to 8%. We've lost 1%, but we've gone down from unlimited loss to a capped loss. So this is a iron condor. This is something that most traders do. If you are able to predict a range, this is the best way to go forward. Now I'll share something that I have done. As most of you are aware, I've just started a trading firm called Shipra Holdings. So I've just started it about 2 weeks ago. I want to share a position that I have taken so you get an idea of what I am doing. So this is live position that I have taken. I am assuming that Nifty will trade between 21,500. You all were talking about 22,500. I have taken a 1,000 points buffer, 21,500. On upper side, you had told Nifty will go to 24,500. There also I have taken a 1,000 point buffer. So I have sold 25,500 call options. I have sold 21,500 put options. But in options, you have many ways to look at it. Now there's a budget in between. So I don't want to take a risk. What I have done is, I have bought partial quantity. My trade value is 14,000, but I have just bought 2,700 quantity of 22,000 put option. What this has done is, while this should have been a straight line, then a downward triangle, I have made this straddle here. So what will happen in case things go very good, market is stable. Now my investment here is 23 lakh rupees. And correct. My investment here is 2.45 crore rupees, on which, forget the max profit, at these levels, I am coming out with 10 lakh rupees, which is 4.1%. Whatever values we discussed, you were talking about crazy numbers. We were generating 10%, 20% in 1 week, which is not sustainable. I like to work at 2.5%, 3% per month, because my equity is also going up and I'm satisfied with 3%. So this will give me 4% returns in 40 days, 1% per 10 days, if the market remains stable. Now what can happen? Market can go up. If it is going up, my break even is 25,500. 25,572 because I've taken premium, that is 10%. Nifty going 10% in 1.5 months is a very, very rare thing that can happen. But even if it happens, I am sitting on a portfolio of equity that will parallelly keep going up. So there I make money. Now if things go down, as an investor, let's say market crashes. Market goes down to 20, you were talking 22, I'll say 21,800, which is my best possible scenario, or 21,500 only. Then because I have bought and sold, on expiry, if Nifty is at 21,500, I come out with 23 lakh rupees, which is 10% of the money I have invested. So no matter what loss I have suffered in my portfolio, a good chunk is recovered from here. And other benefit is that portfolio I will not be selling. It will eventually go up. But this money has hit my accounts. So this is my profit that I have realized, while my losses are unrealized. So this is one very good way by which I am hedging my portfolio also from any losses that can happen. So yeah, these were some of the strategies also that I wanted to share. Now guys, if any questions, if you want, please ask me. There is no such rule that only Vikas can ask questions. Anybody is free to ask.
Writing a call and writing a put and things like that.
But when you're writing multiple calls, multiple puts, the amount of margin that is required, does the market recognize that you're doing a strategy or a hedge?
Yeah.
Or are you paying for
Yes, yes, yes. So your broker gets all the details, no? If you've sold any one, so selling a option without any hedge is called naked option selling. If you sold a naked option, margin is higher. The moment you hedge it by selling opposite side, that is if you've hedged with other is selling a put option. The moment you hedge, your margin get released.
So your margin is adjusted
Yeah.
for the risks.
Immediately, the very second you take the trade.
And you spoke about you personally target about 3% return on. So when you're talking about 3% return, you're talking about 3% return purely on derivatives or
Purely on derivatives.
not after
Whatever my portfolio is giving is extra. Whatever equity is giving is my extra. That I don't even consider it because I don't plan to sell it. So that is why I whenever people ask me for tips, that's what I tell them, that I am not trading, I am not selling any equity. I am only buying, pledging, and I am doing derivatives. What will I tell you to buy?
My
Simple.
last question is, you personally when you are
Before that, I just want to share something. So why 3%? I'll tell something. Now let's say forget 3%. You are making 2% per month. That works out at 20% per annum, 25% per annum. Anybody? Any guess? Correct. If you are able to generate 25%, your 1 crore in 10 years will become 10 crores. In 20 years will become 100 crores, and in 30 years will become 1000 crores. That is how compounding works. You can check this on a calculator. So I am very much satisfied with 3%. Why do I even need more? No business is giving that much return. The problem here is that when it comes to stock markets, people become greedy. If you want more return, go to a casino. No? You will double your money in next 5 minutes. Don't do it here. You will end up losing only. There are people, I'm not a stupid here who is sitting learning from 5 years to give you money for a jackpot. I'll know how to manage. Same way like me, there are people much smarter than me who are sitting here to take your money. If you are going for 10%, 20% returns, there are very high chances that 1 or 2 times you get lucky and make money. Third time a person like me will take all your money. Not at all. Not at all. Nifty, what equity I'll have? I am telling you guys because most, if not all of you, most of you are not experienced enough for this. And you get trapped. See, it is very good because it is capped, but if you see the profit versus loss ratio, max profit I am making is 79,000. Max loss I am making is 3 lakh rupees on an investment of 9 lakh. Losing 30% of your entire capital is a very big hit. To cover it, it will take you 1 year. So you have to know it. Now, if I am taking this, like I was telling that if Nifty stays between this range, I will come out with profit. I will never sit here. After I'll show you some time decay also. Let's say 10 days have passed. I would have already made I'll show it here itself in my current strategy. Now say if 10 days have passed, on 27th, out of my maximum profit of 10 lakh rupees, I would have already made 5 lakh rupees. And my call option, which is so far away, it will have no value. There is no point in me sitting there. So what I'll start doing is, if market is here only, I'll start bringing this closer. If market is going here, I'll start bringing this closer. So that way, this 4%, whatever the 3% that I have started with, I'll make sure that I come out with 4%. Because see, when I'm telling you 3% per month, I am not making 3% per month. There are months where I am making 5% per month. There are months where I am making 2% per month. There are months where I am even losing money. At an average, I try to come out with 3% or 2%. 25% and I am good. So that kind of risk now I cannot advise to you, because if you start it, I know many adjustments that I will do to come out in profit. Even if I don't come out in profit, like I told you, everybody goes wrong. I'll make loss, but I know where I will restrict my loss. I know how to fight that loss. As a beginner, you might not know it. So that is why I have given you only strategies where it is backed by equity. Either you are ready to sell equity or you are ready to buy equity. If my entire trading corpus is 100 rupees, I think 5 or 7 rupees are against equity. Rest everything is without equity. I'll have to fight it out if things go wrong. Now, I have shown equal quantity. If I share some other trade of mine, so which one? Where there's a difference? So Tata Power. Now, this is one stock. in which I am holding good equity. So in this case, if it goes high, I don't mind giving delivery. But I don't want to take a lot of stocks. So what I have done is I have sold only 2700 put options. So if it goes higher, I am ready to give delivery because I will make a killing in my portfolio. So I have taken a risk. But if it goes down, because my quantity is so low, at one point of time, wherever if you see, the blue line shows profit today. The green and red shows on expiry. So as it keeps coming down, my profit keeps increasing because my put will give me very little loss, as against that my call will give me very good profit. So when it comes to a particular point, I'll exit it in profit. So at no point will I ever take delivery. Parallelly, at no point I will give delivery of my equity. I am ready to give it, but I'll keep fighting it. I'll come to a straddle. This 320 put that I have sold, I'll keep selling it 340, 360, 380. I'll even sell a 400 put option if I have to, but I will not give my delivery until and unless I have to. It goes to 600 in 2 days, then I cannot fight it regardless of what I do, then I'll give delivery. So these are some combinations which you will eventually pick up. Right away, it is better to go for safer things if you want to start. A small company, if I only own a company I listed, there are very high chances that I can manipulate. So that is why now Reliance is there, HDFC is there. Even if you sit with 1000 crore of idle money that you are ready to pump, you cannot you cannot manipulate it because it is worth lakhs of crores. Your 1000 crores are peanuts. So that is why only big companies are there, and I advise that you trade in derivatives of only Nifty 50 companies. Don't even go for illiquid companies.
And do mutual funds also do this hedge?
Mutual funds are not allowed to trade in derivatives. Portfolio, they are anticipating that it might go down. Then only to hedge it, they can buy put options which are treated as an insurance. So that is the only thing allowed, but neither mutual funds nor any individual. As an individual, I can, even if you want to give me money, SEBI does not permit me to trade for you. So it is not allowed. No mutual fund is not allowed to trade options.
Are there hedge funds where we can invest in?
They cannot trade. You cannot invest anywhere that can trade in options. Only they have permission only to trade in equities. SEBI does not allow them because it is like I've been sharing. No, see, if a mutual fund fund manager is not a god. He can also go wrong. If a fund manager goes wrong, out of your 10 lakh, if he's burning 3 lakh in 1 month and coming to you, probably you will take the loss, but a person who doesn't afford, he'll suicide. So that is why it is not permitted. Subject is complex, yes. See, like I was sharing, initially it is very complicated to understand, then you start enjoying it.
5% of the people who trade in futures and options lose money on this.
Correct.
What do you think separates you since you are more?
They are greedy, no? They want to make a jackpot. Strangle. My margin blocked is 17 lakh rupees. So I would have to have 17 lakh worth of margin or cash to take this. But if the situation is reversed, for a buyer, same position, if he is buying same quantity, buyer does not need to give margin because his loss is capped. He only has to pay a premium. Same quantity, he has bought it. While I paid 17 lakh rupees margin, he has got it at 1,66,000 rupees. So people come with the idea that they will invest 1 lakh. Some magic will happen. The stock market will crash or it will go for a zoom up and they'll come out with 6 lakh rupees profit. So their 1,66,000 within 1 month has gone to 6 lakh. It happens. It can happen once in a year. It can happen twice in a year. Rest 10 months, they lose that money. So you can make jackpots by buying options, but those jackpots will come once or twice a year. Rest entire month, slowly you will keep bleeding. And 80 to 90% people in the market who are trading in options are only buyers. There are only 10-11% who are sellers, and those 10-11 also there are probably, so like you were telling, 95% people are making losses. If you study that entire thing, no, 95 are making losses, 3% are not even covering the brokerage charges. There are only 1 or 2% in the market who are making money. But you see the good part, today if I am among that 1%, what 99% people are losing, I am alone making it. So you realize the kind of money that can be created also. See, all of us are smart. Now everybody is intelligent. Don't you think we are smart enough to be in top 1%? I am sure we are smart enough to be in 0.001%. Then why can't you be in that 1% in stock market? Very, very easy. My whole, I tried a lot to cut it short, but I just checked, I have still gone